Welcome back to another episode of What Works Wednesday. Today we're going to talk about credit scores. This is a huge topic, not just among self-employed professionals, but just in personal finance in general. And it's a topic that I get asked about constantly. If I do this, how's it going to affect my credit? What is my credit score? How do I improve it? How do I get approved for certain loans and interest rates? All of that goes back to our credit score. And it's important for business owners because oftentimes we need certain types of lines of credit, loans, to be able to cash flow our businesses, especially in the early days. So let's talk about it. Let's talk about how it's calculated, keys to success, and how to think about credit, really, because we have a huge credit crisis in the US with people just being swamped in debts and loans and bad credit scores, which then make it really hard to continue to move forward and progress in your personal life and in your financial life. So what is a credit score? A credit score is a score given to each person that would not be defined this way, but I would say it's the how trustworthy are you if I were to give you a loan or a line of credit score. So lenders, credit card companies, they're going to say, all right, you want to get fill in the blank, approved for a credit card, approved for a mortgage. Well, that means we're going to have to give you money. And how safe is that money going to be in your hands? Are you going to pay it off on time? What's your history of credit in the past? How reliable are you? And that's going to educate if you get approved for the loan and what some of the stipulations would be. Interest rates, total credit line, amount, things like that. So when it comes to lending money, we need to know how credible you are, and that is what a credit score essentially does for lenders, is it gives them a number that says, okay, we can get an idea of what risk we're going to take on by giving you this loan. And if it's going to be more risk, maybe we charge a higher interest rate because we're taking more risk to give it to you, or we don't approve you for as much, or we don't approve you at all. So how is a credit score calculated? What do you need to be thinking about in regards to that? And there's 5 areas. The 5 areas include your payment history. Do you pay on time? Do you consistently pay on time? Are you consistently late? If so, typically how often are you late and by how far back are you late? The amount owed. So, hey, you have all these loans, you have all these credit cards. Are they all maxed out? Do you owe a ton of money? Or do you have a lot of credit, like you have a big line, but you're not really utilizing it? There's a lot of room to pay off, or there's a lot of room to take on more. You're pretty healthy. You don't carry balances a ton. Length of credit history. Are you churning and burning credit lines, moving all the time, setting up new lines, shutting them down? Which just shows you maybe don't have a longevity of trust with any one credit line. So the longer you have things open, the longer people are trusting you with money, the more history we have to view things like your payment history, how much you've utilized it. So the longer the history, the better. And then types of accounts you have and recent activity or new credit. So let's break that down a little bit. So payment history. This is the biggest part of your credit score. It makes up 35%. So over a third of the score is payment history. This shows whether or not you make your payments on time. So are you making late payments? Are you making just the minimum payments? How far behind are you on any one bill? Obviously, if I'm a lender and I'm going to lend you money or give you a credit line, I want to make sure you're going to pay me back on time. That you're not going to just always pay the bare minimum, or you're not going to get behind. So the higher number of on-time payments you have across all of your credit lines, the better. If you are consistently responsible and using your credit card and paying it off every month, making your mortgage payment, making the payment on your personal loan, your installment loan, your student loan, all of that is going to bode well for you on the biggest weighted part of your credit score. All right, second is the amount owed. So this makes up 30%. So it's still a pretty significant sum of your credit score. So payment history and the amount owed make up the largest chunk. This is based on the entire amount you owe. So not just any one line. So if you have maxed out one credit card, but you haven't really touched your HELOC and you got a large line of credit on your HELOC, that's okay. It's still a lower amount owed. But generally, they want to make sure that that stays low. If you have really high balances, a lot of maxed out credit cards, that can allow them to infer that you have some financial trouble, that you're living on credit, and that you're not able to pay that off. And so that makes you a riskier person to lend money to, and therefore your score will go down because you're not as trustworthy. All right, next is the length of credit history. So this makes up 15% of your credit score. And again, this is just the longer the history on any one line. So if you have a credit card, if you've had it for years, we can look back and we can look at the other things. How much have you put on there? How many consistent on-time payments have you had? Have these companies shut your line down or kept it open? And so this really allows them to get a history, which kind of backs up some of those other two bigger pieces. But what I find is, especially with credit cards specifically, people will close them quickly. Or, hey, I'm trying to get out of debt. I'm not going to use my credit cards. I'm just going to cut them up and literally close the line. But the problem with that is now that line is closed. So you're not approved for as much credit because your credit card just closed. And maybe they don't have as long of history. So what I tell people to do is don't close your cards. You can consolidate them. So if you have 3 or 4 credit cards, you can call the bank and say, hey, can I put all these credit lines just onto one card? Maybe a card with a lower annual fee or less benefits, whatever it may be. And then additionally, just put a basic auto payment on there. Hey, I'm going to just put Netflix through my credit card and every month it's set to auto pay off. So it's just a little bit. That's a healthier way to use your credit lines where you can keep the line open for significantly longer. You utilize it just a little bit. So the how much you owe piece is still good. And you can create more lasting on-time payment history by just having a card that you're not maxing out all the time, but you just have one small auto payment on. So length of credit history, trying to keep these cards open, trying to keep your lines open longer. Like having a mortgage is a great one because it's a 30-year mortgage or a 15-year mortgage. You might, even if you don't live in the house that long, you may have it for a really long time. Like you may live there for 5-10 years. If you're making on-time payments, that's great for how much you owe, payment history, length of credit history. All right, the next one is types of accounts you have or credit mix. This makes up 10%, so it's the smallest of the 5 pieces. And really just having a mix of credit, right? So it's not just credit cards. It's not just a mortgage. It's not just a car payment. But you have kind of different areas of your life. I have a car payment. I've got my mortgage. I've got my credit cards. And I'm handling all of them well. I'm making the payments on them faithfully every month. I'm not maxing out all my lines. But having the different lines of credit or lending shows a potential lender, okay, they're being responsible across many different fields. Many different types of people are trusting them. They got approved for a car loan. They got approved for a mortgage. They got approved for credit cards. And they're making payment history well. They're not maxing it out. And there's a history to show for it. You can begin to see how these different things make someone more confident in you and give you a higher score. And lastly is your recent credit activity or new credit. This makes up 10% as well. So the mix and the new credit activity is 10% each. And new credit activity kind of goes with length of credit history. So are you opening a lot of new accounts recently? So on the recent activity, if you've opened up 5 or 6 credit cards in the last couple months and you're applying for another one, well, maybe that credit lender is going to look and say, all right, they might be in some financial trouble where they're trying to get cash quickly. Maybe that means they're not going to be as stable. So opening up a bunch of credit lines back to back to back is hard. This is one of the reasons why you'll hear people say when you're in the process of underwriting for a mortgage, don't go buy a new car or take out a new credit card. They don't want you to do anything else with your credit because you're going through one of the biggest underwriting decisions that's looking at your credit history. And if they start to see lots of new credit activity, it could actually lower your score. So I know it's really common for people to say, no debt is best, like always zero debt. But having some credit, some lines can be really, really helpful for you. Having a credit card that just has a little thing on it that you're paying off every single month. Having a mortgage is a great opportunity. Just taking out these little things. You don't need to overdo it. Don't have 6 credit cards. Don't take loans for every little thing. But if you can have a mix of loans for an extended period of time and handle them wisely and responsibly, and you're not just taking them all out at one time, it's going to create a picture of health for anybody who's going to be looking at you and willing to give you credit. So that's how a credit score is built out. Your payment history, the amount you owe, the length of your credit history, the credit mix, so like different types of loans, and new credit activity. All of those in the different weights come in to give you a score. So each one of those 5 give you a score, and together they'll give you your what's called your FICO score or your credit score, which ranges anywhere between 300 and 850. Good credit is going to be somewhere 720 and above. Most lenders will want to see that to give you the most advantageous rates. So if you're below 720 or 700, you might still get approved, but it might be a higher interest rate, or it might not be at as advantageous terms. You might not get as much credit given to you. And really that's why that's important, is we want to make sure that you, whether it's in your business, trying to get a business loan, whether it's just in your personal life, credit is really important because it allows you to get more advantageous credit lines. It allows you to show that you're a trustworthy person for someone else to invest in and give you money. And that can really be a powerful source for you as you go on to build your wealth. So with that, I'll leave you. Remember, go forth, build the life you want, and prosper.